Yo, what is up, guys? This is the Tony and Dakota podcast. Appreciate you guys watching. We actually had a special request from somebody to talk about this topic that we're going to talk about today. What are we going to be talking about?
We're going to be talking about the real estate market. It's like one of the hottest things to answer. It seems like every single YouTuber thumbnail is the market's going to crash. Everything's going to crash. This is the end. Get ready. Run for the hills. Sell everything.
Yeah, so somebody asked, they're like, dude, do you think the market's going to crash? And the short answer is yes. But the real question is, when is it going to crash? And everybody seems to think that it's going to happen like now, I guess. I don't even know when everybody thinks it's going to happen. They just keep saying that. They're like, I'm waiting to invest in real estate until the market crashes. What do you think about that?
Well, I wrote like a little bit of an article on this, and then I think like it ended up getting like a 50% click rate, which is crazy. But I always go back to 2008 and how so many banks stopped giving builders money, and there were so many general contractors and house builders that went out of business that around 2008, that entire decade of 10 years, we had built like 27 million homes. And in the last 10 years, we've built 5, 6, 7 million homes. So there's this huge demand that wasn't being filled. And when you have that much of a supply gap between how many people want to buy a house and how many houses are actually available, that's what we started to see in like 2019, 2020, even through COVID. People were terrified of this virus, and there were still people buying houses without even seeing them, marking up offers higher than, I mean, we can see it right now with like, I'm trying to buy a color printer, and there's not enough printers. So people are paying like $200 more for a printer than the actual price of the printer right now because there's a shortage. And I think that happens sometimes in markets. And so I don't see the demand, even with like the mortgage foreclosures that are coming, even though some people have said that they're worse than 2008. I don't see that creating enough demand to cover all the folks who want a single family home right now.
Can you send me that chart that you have?
Mm-hmm.
Send it to me on Facebook. I'll pull it up here real quick so we can show the people like.
Oh yeah, I can edit it in later too.
Okay, cool. Yeah, so we'll throw up the chart that shows you guys like oh, actually he's just got it right here.
Well, yeah, but I don't know. They won't be able to see that from here.
But basically it's just a chart that shows you exactly what he was just talking about, is how many homes have been built. And it's a little bit harder to conceptualize whenever we're just throwing out the numbers, but when you actually see it on a graph, it does make a huge difference. So yeah, a lot of people have just been, kind of saying that Tony and I, they're like, dude, you guys got in at the right time. You guys got really lucky, which is partly true. There's no question to that. So in the beginning, when we first started, people thought we were crazy because we would buy a property and then we would, rehab it, or maybe not, and then we would pull out all of our money against that property, which makes our cash flow a little bit less, but we're able to continue to do that. And we did that time after time, and everybody's like, whoa, like you guys need to slow down. You're going to get over leveraged, and maybe you shouldn't use that much debt. And really thought that, like, they didn't say it, but they thought we were kind of crazy and a little bit like
Stupid.
dumb. Yeah, like just dumb.
It's like the opposite of the Dave Ramsey snowball. He's like, pay down the one that's like $50 and then use that success to pay down the next one. And we were like, okay, let's take out this loan, and when it starts to generate cash flow, that'll make our numbers look better. Then we can borrow more money. And then after we borrow more money, let's borrow more money. So we created this debt snowball and like expanded as quickly as possible. It allowed us to grow a lot faster, borrowing as much money as we did.
Yeah, so when we first started doing that 3.5 years ago, people thought we were really crazy. Well, some people did. A lot of people did. I would say 90%. Even some real estate investors were kind of like, whoa, you guys are like kind of going real quick. Maybe you should slow down. Maybe we should have. But now that, this crash or whatever that everybody's talking about is potentially coming or whatever, we look at it like, man, we see it the exact opposite. So the reason that I don't think a crash is coming in the next 3 to 5 years is because the massive amount of money that they printed. I'm sure you guys have heard me talk about it a little bit, but inflation is real and it was like ridiculous. I can't remember the exact like statistics or anything like that, but I think it was like 30% of the money that was created in 2020 is like the entirety of the US dollar since we created it. That's how much was printed back in 2020. So that is crazy. So that debt actually kind of protected us against inflation and then also owning the assets because we still owe the same amount and our property values like didn't necessarily go up. Well, they did go up, but in my mind it was more inflation, which means the dollar's worth less, which means that you see it going for a higher price. It doesn't necessarily mean the value is increased, but the dollar is now devalued, which means the property goes up in value. So that's, I think, why we saw the spike and why we're going to continue to see a spike, because a property for $100,000 and then you print up a bunch of money. Now everybody's got $100,000, which actually kind of seems like everybody's got a bunch of money right now. But everybody's got $100,000, so that means more people can buy that, and it actually is less to them because now they got so much more money. So I think that's why the demand has really went up and why we're not going to get below where we're at now.
Well, I think that the demand is going down, but I think that the value of property is going down, but the value of money is going down so much further that the dollar amount that the property is being sold for is gonna level out. Like we're not gonna see the value of properties drop because inflation hit, and even if the real estate market only goes up by 3%, inflation's at 5.3. Or even if the value of real estate just hit zero, let's say it goes nowhere for like the next 5 years, the prices are going to go up 25, 30%. And so even with these foreclosures happening, the banks are still in an equitable position. It's not like the market tanked and the mortgage companies aren't able to get out from underneath of their debt because they own the property for, say, 80% of what it's worth because these people bought it 3 years ago and the prices went up so much that they're still in an equitable position. Also, Dakota and I have noticed that a lot of banks are like working with people. They're moving a lot of their debt to the back end of their loan, and the people don't realize they're going to get hit with this big balloon at the end of their loan. They're going to have to come up with like 10, 15 grand. And they're raising interest rates a little bit, like incrementally, to kind of punish these people for getting behind and for working with the banks. But banksters are gangsters. They can do whatever they want. They can tell the folks who are behind on their loans, like, hey, we're going to foreclose on you anyways. You missed too many payments. We don't care what you want. You're not going to keep your house. Or they can just move all the debt to the back end of the loan, charge them a higher interest rate, plus points, plus fees, all kinds of stuff. Like we've seen these bank loans go up $15,000, $20,000 when these people really only owed like $8,000, and that was just to get the property paid off so that we could buy it, so that we could end up flipping the house. So I don't know, with the foreclosures being more than 2008 from what I've seen, I feel like folks like Dakota and I are helping flatten out the curve because we're able to get to people who aren't going to be able to keep their properties, and we're helping them figure them out. Like we bought 6 so far, we might buy a 7th one soon. And there are investors just like us. Because of the Freedom of Information Act, we have access to tax information and can find out who's going through pre-foreclosure, target those people, get in front of those people, and help those people get out of the situation that they're in so they don't lose their houses. At the same time, though, I'm like, man, it kind of creates a situation where people who hold on to physical assets that are like us, who are leveraging debt and trying to be as smart as possible, are going to end up rich, and folks who are the normal, average, everyday people, when they get their money and they go buy like I don't know, the
iPhone,
a brand new iPhone, or
big screen TV,
like the car that they always wanted, like their dream car. Or, they go buy an additional house, like a lake house, because interest rates are low right now and they heard that would be a good idea, and they create more liabilities for themselves. I think the rich are going to get richer and the poor are going to get poorer, and that's just a situation that has been created because of printing so much money. And because folks like us hold on to physical assets, we're going to end up being exponentially richer than the average person, while they're going to see all of their normal everyday expenses go up 5% a year for like the next 5 years.
Right. So basically, we're going to continue to see that too. Our expenses are going to increase, but also our net worth is going to increase and the rent is going to increase. Basically, everything is going to go up with us because we own assets. So, I mean, it still affects the rich, but it actually probably helps them more because the assets are going up faster than what the expenses are. So, yeah. And then one other thing that you said the demand is like you don't think the demand is there, which I agree with. It's not there like it was, but I still think like we went from like, here, probably like, 2018 to 2019. Then we went to here in 2020. And then now I feel like we're like here.
Yeah.
Like we're still like pretty up compared to what we were. It has went down a little bit, but it's still crazy.
Yeah, I was talking to Vaughn Lurie at closing. We were selling one of our properties, and she's like, "Yeah, like has business been good?" And I was kind of like, "Yeah." She's like, "I just noticed that like houses aren't really getting like 14 offers anymore. They're only getting like 3." And I was like,
I thought you said 6, but yeah, it might have been 3.
I was like, "Well, that's accurate. I mean, that's kind of accurate right now. It does feel like it's slowed down a little bit." I mean, maybe we'll be in a situation soon where it'll take us like a whole month to sell a house.
Yeah.
But
I remember we just sold one, and a guy it was well, never mind. I won't even tell you about the ethnicity. But anyway, the guy was like, "Yeah, well, I want to take back my offer and change it because it's been on the market for a while." I'm like, "It's been 3 days."
Oh, it might have been 5.
No, it was 3. It was literally 3. We posted on Friday, and this was on Monday. So I was like, "Dude, it's been 3 days. Apparently, that's a long time in this market."
And if you need additional something that kind of confirms our viewpoint, I think, is these hedge funds with massive amounts of money. Maybe Blackstone has like $600 billion under management. They're buying properties. Open Door is buying properties. There are companies and hedge funds right now that are buying properties for more than flippers, wholesalers, individuals who have their own private mom and pop landlording businesses. Hedge funds are buying them for more than those people would be willing to pay because they see just how good of a hedge a physical asset is to inflation. Now, they're not doing it in Fort Wayne, Indiana. They are buying houses in Indianapolis, though. They are buying houses in Las Vegas because everybody's moving over from California. They're buying houses in Colorado right now, in Arizona. I think like one of the Carolinas. I can never remember if it's North or South Carolina. But they're buying up these houses for more than normal people would pay. And they're renting them out. They're not buying like farmland or big commercial. They're making small purchases, but they're making a whole bunch of small purchases, buying 3-bed, 2 baths, the typical single-family American home. If you guys want confirmation of that, just go on Google, hedge funds buying up single-family homes. There's article after article that's like, the hedge funds are taking away your properties. The corporations are taking away your properties, and I think, so for us, we look at stuff like that, and it's just confirmation that we're doing the right thing, while the average American is thinking, is the market going to go up or is the market going to go down? Hedge funds are like, dude, let's buy up as many single-family homes as we possibly can right now.
Yeah. And then, another thing is, like, we do have to say that, we've only been in real estate for 3.5 years. So it's not like we have, all this knowledge or anything like that. And we haven't seen the cycles, which everybody kind of, explains to us, which we agree with, obviously. We haven't been around since '08, but that's all anybody talks about is '08. Like everybody says that it's been going to crash since basically '08. Like, they're like, oh, '08's going to happen again. We've been saying that since '08. And so now I feel like people keep using that as an excuse to not get into real estate investing. It's just like, oh, I'm just waiting for the crash. I'm waiting for this. It's like, guys, if you're waiting for it, then you're never going to get in anyway.
Yeah, it's been a whole 13 years, Maybe we should just hold on for another 13
right
before we get in.
Yeah, I don't think that it has to happen in a certain amount of time. Like, I feel like people's only reasoning for why it's going to crash here soon, from what I've heard, is literally only that it hasn't happened in a while. That's literally the only reason. There's like no data. Well, other than the foreclosure thing that we talked about, there's no data that supports any kind of crash coming in the near future. It's most people are just like, well, it's got to happen here soon because '08 happened and we need another cycle. So,
Well, another reason why too, if you look at the reasons why real estate is going to stay up, properties that are already created right now are in the supply chain. So we have a supply of properties. Builders are trying to build houses, but you saw in May of 2021 lumber skyrocket as a residual effect of limiting trading with other countries and limiting our import of lumber. So I'll put up that chart too. It's like you could build 2.5 houses, whereas previously that was just the price of lumber. Previously you could build 10.5, then you could build 2.5 with the same amount of lumber. So lumber costs were so crazy. Material costs went up, and they kind of stayed up, partly due to inflation, partly due to trading and our access to semi-trucks and who's driving and who's working in the factories. Like a lot of people quit making doors, quit making windows, quit making garage doors because, COVID limited those people's ability to work. And because building materials are still expensive, you don't see this huge rush of builders just building and building and building. You see people building, but it doesn't seem like it's this extreme amount of properties being built. It's kind of just folks who are willing to pay a little bit more for the perfect house that they absolutely want. It seems like folks are mainly just trying to get a property immediately rather than waiting a year for a house to be built right now. So another thing that is going to continue to keep demand up is that money costs are low. Like the Fed voted, and they know that it's bad for the economy when you raise the interest rates. So interest rates have been historically low, and they're going to stay low-ish. We've seen them come up a little bit and down a little bit and up a little bit, but like money costs are going to stay low for like at least the next 5 years. I think the Fed said 5 or 10 years. They vote every so often. And that's going to encourage people to buy versus rent because it'd be about the same price for them to do either.
And everybody's got money right now. I mean, it seems like anybody who had money has more money. From what I've seen anyway. There's like, I don't know. I feel like everybody's just like, yep. Or maybe we just got more credible and everybody's okay with lending to us now. But I'm just like, man, I feel like there's more money now than there ever has been. Well, obviously, they just printed up all of it. So there's more money than there's ever has been. So everybody's got more money to lend out, too, which is pretty nice for us as long as we continue to use it for the right things. But, yeah, interest rates are ridiculous. I refinanced my house, actually, at 2.25, which is just nuts. I mean, 2.25 on a property is crazy. I wish we could get that on some investment properties. We'd be sitting really good.
Well, I think something that's interesting here too. So in the Midwest, a lot of investors kind of like laugh at the Midwest because of how low our prices are, and Fort Wayne's one of the lowest priced cities. But if you give someone a $1,200 stimulus and they have 4 kids and they get $1,200 for each one of those kids too, they all of a sudden have a down payment. I think that demand went up in the Midwest more than it did anywhere else because it artificially created so many buyers.
Oh, yeah.
And I've seen our prices double in like the rough part of town over the last 3 years, even though historically there's little to no appreciation here in the Midwest. I think that we got the biggest benefit by the printing of money and the handouts and that sort of thing. Because you give somebody in California $1,200 and they're like, oh, cool, I can make a third of my rent payment.
Right.
You give somebody $1,200 here in the Midwest
Rent's
and
covered for 3 months.
yeah, they're like, oh man, I could just not pay my landlord, have enough money to go buy my own house.
Yeah. So what do you think is like, if you had to pick one, Was it inflation or demand that made those like the houses in the rough parts of town go up by double? If you had to pick one.
Yeah, I think. Well, I think it's inflation, but I think more was like the amount of money that was going out to people. Just be like receiving inheritance or something like that. You know, it's like all of a sudden there's this massive handout. It's like, wow, now I have a down payment, and seems like it seems like demand is really high too.
I know, that's why I was like, man, I don't
Yeah.
know which one it would be.
I think that there's a lot of people to like. There's more people every year. We haven't hit, apparently if you look at theories, we might hit our population height, and then there's a theory out there by some of the smartest people in the world that eventually we're going to hit this maximum number of people in like 2050, and the number of people who are being born and the number of people that are dying is kind of going to even out. So we might not have the same population problem, but there's more and more people being born every day, and a lot of people our age, like I just turned 30. When you get close to 33 years old, we heard this from one of our bankers, you're either buying your first property or you're buying your second property, your forever home. You're either buying a starter home or your forever home. And it seems like that's kind of happening. And it seems like I noticed a lot of folks, like I was from a small town growing up called a villa, just like, I don't know, 9,000 people or something, or 5,000 people. Dakota was from Kendallville. It's like 17,000 people or something. 12,000, I can't remember.
I think it's like close to 10
but
in Kendallville.
all of the folks around these smaller towns who are, the millennial generation decided to move to Fort Wayne because it's the nearest like big city. So man, that's a hard one. Demand, inflation. I mean, they both
Played a part.
played a big role.
Yeah, because I think about like the rougher sides of town too, and then how many people that bought there are investors. I mean, like I would say that 60% are investors at least, like over half, at least a little bit over half. So then I'm like, man, like why did prices go up so much in the last couple of years? And yeah, it's hard to say if it's demand or inflation. It's like it's obviously both, but which one played a bigger role? And so, yeah, I think that everybody is getting it mixed up though, where they only think it's demand, when I just think inflation happened, which is why I think that the market crashing isn't as plausible because like they're not going to go below where they're at now because we just have so much more money. Like so, yeah. But I do think it is funny whenever people talk about us coming in at the right time. So that's kind of what I want to explain to you guys is that for us as investors, it does not matter on the timing. I was actually watching Bradley and then Ryan Pineda, and it was like, it was funny. I was watching it with Diana, and like he's just asking all these questions. He's like, yeah, but like, how do you find it? Like, we're in Vegas and then they're making offers and they're going so much higher. So like, how do you even get the property? It just doesn't make any sense to me. He's like, dude, like Ryan's like, that person that has it listed who's getting multiple offers, that's not our client. It's like, cool, like you go do that. But like, that's not who we're going after. And so like Brad just like literally didn't get it. And I was like, man, it's like crazy to me how many people don't understand. He's like, yeah, but you just got in, you got to get in at the right time and stuff like that. And I'm waiting for this. And it's like, guys, it does not matter because we're in and then we're out 3 months later on our flips. So that means that like, if the values fall and then now that property is only worth 100,000, guess what? Now we're buying it for 40,000. We're putting 20 into it, and then we're selling it for the 100 that it just dropped from 150 to. So if we went from 150 to 100, now we're buying it for 40. We're putting 20 into it. We're still selling it for 100. For us, it does not change us being able to make money on that property or not. It just means that we offer a different amount based on where it's at. The only time that we are going to have an issue is whenever we bought that property, we're in the middle of it, and then the prices drop, and then we're probably either going to net out or maybe lose a little bit. But then when we go to buy the next ones, then we're going to make up for it.
Yeah, and we're kind of lucky too in that, even if the prices drop overnight, we're in a market where we can usually refinance and then rent the property out. So we still have multiple exit strategies. If we can't refinance out and rent the property out, we'll refinance out and then seller finance it to somebody for it to be their fixer-upper home. So I think we're a little bit more fortunate than Ryan, where like if things dropped in 2 months, he might
Right.
be pretty screwed.
Yeah.
But
And
now he's got multiple streams of income, so he can
right.
always turn it into content and
Yeah.
make his money back.
But it's also like he's in obviously a higher price market. So like if you want to talk about that too, I mean the difference in Midwest pricing and Las Vegas pricing.
Yeah, I mean, our average home that the typical person is going to come in here and buy is about 150,000. The typical properties that we're usually buying, like I think our average rental per door is like 45,000 after repairs. A lot of times, our prices have started to go up a little bit. I felt it creep a little bit. We might be closer to like 50K a door or something, but that's so low compared to the rent that we're able to get. And now it seems like rents are creeping toward the $1,000 mark no matter where you live, even in the rougher parts of town. So it's like that's the 2% rule. You know, we've got a unique market here where we're always going to cash flow. And if we can't cash flow, we're going to Airbnb.
Yep.
We just started doing that. So I think that if you look at some of the mentors like Gary Vee, I remember Gary Vee like jumping on this one guy when he was on stage because the guy's like, I just want passive income. That way I can sit back on like a beach and just enjoy myself. And Gary was like, there is no passive income. Passive income's a lie. There are basically two things you can do for passive income. And then like he named one other thing and he's like, real estate, but you have to hope that it goes up. And I just think that's because Gary Vee grew up in New York where inflation happens and the market looks like this all the time. We invest in a market that's a lot different than that, where things don't go up and down all the time. They kind of like slowly go up and then slowly go down. There's a lot of consistency to it, and the rents go up, and then when the market crashes, they stay there.
Yeah.
So I think that the idea of passive income is still something that really it's like residual income that you can work less hard for. Maybe nothing truly is passive income. Like you should still monitor what the heck's going on in your business.
Right.
You still need to look at KPIs and look at the spreadsheets and that sort of thing. Dakota's better at that than I am. But, you know, there are things in life where you can start them and then they provide residual income to you, and then you can spend less hours doing them. And then you can even hire people so that you can spend even less time doing them. That's definitely what Ryan's done in his businesses, is hire people to replace himself who understand his numbers and his key performance indicators. And then he's been able to just spend 35 hours a week making YouTubes and TikToks.
Yep. Yeah, and so for the rentals and everything, like that is our backup strategy if a flip doesn't go well. Honestly, we would hate to do that, but if the economy ever does crash, it is what it is. And the reason that it doesn't matter what the values are is because if we own the property for 100,000, let's say that we thought we were going to flip it for 150. Now that property's worth $100,000. We're going to pull a mortgage against it, and if it's only worth 100 and we got 100 into it, then what we're going to do is we're going to get 75,000. We'll get a private money lender for the other 25, or we'll put it in of our own money from the company, and then at that point it's going to cash flow, which means we're going to make money every month. That way we can actually like hold it until we can continue to get the appreciation from it at that point. So it's not really that like risky or scary, especially in the Midwest, because like Tony said, our average rental price that we bought is $50,000. It's probably a little bit less than that, but let's just say all in for 50. Our average rent is $713. So if the
probably up from that now too.
Yeah, it probably is up. So that was
850.
that was what it was before. So it's got to be at least minimum of 800. It might be 850. But if that's like the numbers, I mean, let's just say the market does crash. Okay, it doesn't matter. First of all, let's say we could even use bigger numbers. Let's say the properties that we bought were $200,000. As long as it's cash flowing, it really doesn't matter what the value is. That property could be worth $500,000 or it could be worth $50,000. For us, we don't really care. We look at how much it's actually cash flowing. But for our situation, let's say it does go down 50%, which is just unheard of. Now the property's worth $25,000, which still changes nothing, because it's still rented out for $800 a month, and we are still cash flowing. We already got the money from it because we refinanced right away. So we've already got the money from it from the bank. The only time that we could really run into an issue is if the bank said all your loans are due, which I don't know. Everybody talks about that. That is the only situation that I think that we could ever get hurt.
No, I thought of another one. I mean, right at the beginning of COVID, there were some of our tenants that were messaging things on Facebook like, oh, does this mean that we still have to pay? Like how some people were not making their payments. If all of our tenants decided that they didn't like something that we posted on social media, or like all decided that they were going to go on strike at the same time, we would be screwed. That's the only thing that I could think of, is if all of the sudden all of the residual income that we've built up over the course of the last 3.5 years just completely stopped, came to a grinding halt, and we were bringing in zero a month. Even then, there's still a chance that we wouldn't fail, though, because of our flips, because of other things that we've got going on and other forms of income. And I'm sure we would figure it out and be sticky and, get through it. But that was the only time that I was like, man, what does happen?
Yeah, that was
Everybody stops paying at exactly the same time.
right. I would say that was funny because, like, everybody throws out those hypotheticals. They're like, well, what if nobody pays rent? I'm like, yeah, all 35 of our tenants are going to stop paying rent at the same time. Like, how likely is that to happen? And then COVID happened, and we're like, oh, crap.
That's an actual possibility
Yeah, I was
now.
like, how is this even possible that all of our tenants might not pay rent? And yeah, it was a little scary, but I mean, the odds of these things happening, I think, are not very likely. And so I guess what we do is we take educated risks. And to some people, they look like huge risks. And to us, it feels, in my opinion, pretty small.
I mean, something like unfortunate is going to happen every month when you have 35 properties. Like something uh, is going to happen when you have, well, including you and I, it's like 13 employees.
Yeah.
Something's going to happen once a week, once a month, that it's like, wow, this is a problem and an opportunity. Like we have to figure out what to do. And as long as you pay attention to those things and handle them right away, I don't think that they end up compounding and being like blowing up your entire business. But that's why sometimes we get a little bit nervous when we go on these week-long trips or like 4-day trips, because it's so nice to stay on top of absolutely everything and be that, conscientious about and stable and like moving forward and making sure that things are taken care of. But the things that people project from like doom and gloom and scarcity mindset and that sort of thing, I think it's just a reflection on themselves. Like I was going to talk about this in another podcast where I just heard this quote, and I can't remember who I heard it from. It's like entrepreneurship is just personal development in disguise. So really, I think when a lot of folks talk about how scary it would be to get into what Dakota and I are doing, it's like, well, I think that it's reasonable to be scared. However, I think that it would be a lot less stressful than you're thinking that it would be.
Yeah. Yeah, I mean, I definitely think that it's scary making the decision to finally do it, but then once you're in the middle of it, it's really not that scary. I mean, it's if you guys have ever jumped out of a plane, when you're going up there, you're flying up in that real sketchy airplane that feels like it's about to fall at any second, and then you get it to the door, you get real scared, then you jump, and it's like not that scary anymore. It's just like, all right, like I already did it. The decision or the fear actually really sets before you even make the decision. Once you make the decision, it's honestly a lot easier. And yeah, we've gotten to the point where we make decisions really quickly. And honestly, even if you mess up in that decision, like we've lost money on some flips before, and we messed up in that situation on that decision that we made. But at the end of the day, like it didn't even hurt us that bad because we made the decision and then we tried to make it as quickly as possible. And then we made so many other good decisions that the one bad decision that we make really doesn't affect anything that much. So, yeah, I just try to hurry up and make decisions really quickly and then do the best that I can with the scenario that I'm given in that timing. And I remember Ed Milet talking about basically saying that, I can't remember the exact quote, but basically synopsis is something like, the wrong decision executed like quickly or like, perfectly, is going to be better than the perfect decision that's, not executed or takes forever to execute, or like you have to think about it and then you're planning around it, or it's never even executed. So basically the point is just to hurry up, make a decision, and then execute whatever your decision is, whether it's the right or wrong decision, just execute it to the best of your abilities. And you have to course correct, then sure, course correct. But at the end of the day, just make the decision. So if you guys are thinking about getting into real estate, flipping properties, rentals or anything, we definitely suggest it. It's changed our lives in multiple different ways. Like it's changed our relationships with different people, just because it does, like Tony said from the quote that he heard, it's going to get you more into self-help. It makes you want to become a better person, help more people. We've helped more people by getting into real estate than we probably would have without being in real estate. So there's multiple different reasons. So yeah, if you guys are thinking about getting in, Tony and I are creating a course that's literally going to give away everything that we know about real estate and how we've built up what we've built up now. So we're up to 30 something, 38 doors, I think. We're bringing in over $30,000. I think it's like $34,000 a month in rent. And we did this all in 3.5 years with like none of our own money, essentially. We refinanced it all out, and we did it all without having to use any of our own money, like in the deals, which is pretty cool. So if you guys want to do that, then let us know.
Yeah, check out. We'll probably put a link in the description. This might go up on YouTube, so it'd be in the description. It'd be tiny.cc/LTD flip course, all lowercase LTD.
Yep. When's that coming out?
November 26th.
Yep.
Black Friday.
Yep. So yeah, check that out, guys. It's going to be under $1,000 a month. We might have a promo for Black Friday.
Month.
2 months.
No, you said it's going to be under $1,000 a month.
Oh,
$1,000 altogether. We're not charging you $1,000 a month for the
it's
course.
It's going to be under $1,000 for every 2 months. No, I'm just so used to saying monthly on everything, apparently. So it's going to be under $1,000.
A one-time payment. Yeah,
one-time payment of under $1,000, and it's going to give away everything that we know about how we've built up as many properties as we have. How we flip, wholesale, all of that stuff. So the first one's probably going to be specifically on flipping and wholesaling, just because it's easier, and then we might have one for rentals later, or we might just add to it, but we'll let you guys know. And we appreciate you guys watching. Stay tuned for the next one.
Whoop whoop.
Peace out.